Intel just released an earnings report that split Wall Street. The stock surged 15% after hours, then quickly gave back most of the gains because investors are realizing Intel's AI business is growing, but the cost of catching up in AI may be getting dangerously high. So is this a real comeback or just an expensive temporary rebound? Hey everyone, on Deep Dive Stock Earnings here. We don't just look at price moves, we break down the logic and trends behind them. If you want to truly understand how the market works, make sure to like and subscribe. Let's get right into it. Let's start with the core financial picture. Intel delivered an earnings report that immediately drew intense attention from both bulls and bears on Wall Street, while also exposing a major divide in how investors are interpreting the company's future. According to the company's official results, first quarter revenue came in at $13.6 billion, representing solid 7% year-over-year growth. At the same time, non-GAAP earnings per share reached $0.29. Both headline numbers clearly beat Wall Street expectations, but under GAAP accounting standards, Intel still reported a significant loss of $0.73 per share. The losses were largely driven by restructuring costs, advanced manufacturing investments, and heavy depreciation expenses tied to Intel's capital-intensive turnaround strategy. The sharp split between non-GAAP profitability and GAAP losses quickly triggered major volatility. In after-hours trading, investors immediately began debating what the numbers actually meant. Bulls focused on the stronger-than-expected earnings performance, while bears remained concerned about Intel's real losses and the company's ongoing profitability pressure. Many investors see Intel's stronger-than-expected non-GAAP earnings and assume that turnaround is complete. But the real concern is still hidden behind the company's GAAP losses. It shows Intel's transformation costs remain extremely high, and the company still needs massive spending to support its long-term strategy. Ignoring that financial pressure could still create major valuation risks ahead. Inside this highly divided earnings report, Intel's data center and AI business, also known as DCAI, became the company's strongest growth engine this quarter, as one of the biggest indicators of whether Intel's AI transition is actually working. The DCAI division generated $5.1 billion in quarterly revenue. That represented an impressive 22% year-over-year increase, suggesting Intel's latest Xeon 6 processors are finally regaining momentum. The recovery comes after years of delays and intense competitive pressure across the server and AI infrastructure market. And while NVIDIA still dominates most of the AI spotlight, Intel continues maintaining an important position in servers through its strengths in general-purpose computing and AI inference workloads. Intel's 22% growth in its data center business is giving bulls a lot more confidence right now. Many investors believe Intel completely missed the AI era, but in reality, while tech giants are buying NVIDIA chips, they still need massive amounts of high-performance CPUs for scheduling, data processing, and AI inference. The recovery of Xeon 6 also shows Intel's core position in the server market isn't disappearing as fast as many expected. Beyond data center growth, Intel Foundry, one of CEO Pat Gelsinger's biggest strategic bets, also started showing signs of progress this quarter. According to the earnings report, Foundry revenue grew 16% year-over-year to $5.04 billion. For a business that requires enormous upfront investment, long development cycles, and extremely heavy spending, that level of growth already sends an important signal. Although margins remain under pressure from depreciation costs and advanced node R&D investments, rising revenue suggests more external customer orders are beginning to materialize. Intel is now trying to prove that a system foundry strategy is not just a long-term vision, but a business that is slowly moving toward real commercialization. The 16% growth in foundry revenue is one of the biggest reasons investors are starting to reevaluate Intel. Foundry is an extremely capital-intensive business that requires years of heavy investment before meaningful profits appear. But at the very least, Wall Street can now see that Intel's massive capital spending is beginning to turn into real revenue growth. However, behind the recovery in data centers and foundry operations, Intel's traditional PC business still remains stuck in a weak growth environment. According to the report, Intel's Client Computing Group, or CCG, generated $7.07 billion in revenue this quarter, up only 1% year-over-year. That weak growth reflects the reality that the global PC market remains soft. Even after a short replacement cycle boosted demand temporarily, and despite all the excitement surrounding AI PCs, the category still hasn't generated meaningful large-scale shipment growth, which means Intel's traditional PC business can no longer support the company's aggressive transformation strategy the way it once did. And honestly, the slowdown in the PC business may be Intel's biggest long-term pressure point right now. For years, Intel was able to aggressively expand because the PC business consistently generated enormous cash flow. But now, that core profit engine is clearly weakening. Despite the slowdown in its traditional businesses, Intel's forward guidance for the second quarter still came in above market expectations. Management projected Q2 revenue between $13.08 billion and $14.08 billion, with a midpoint of $14.03 billion, clearly above Wall Street consensus estimates. At the same time, the company expects non-GAAP earnings per share of 20 cents. That guidance sends an important signal to the market. The current growth momentum in data centers and foundry operations may continue expanding over the coming quarters. The fact that management was willing to issue stronger than expected guidance suggests they remain relatively confident about future orders. And on Wall Street, future growth expectations often matter more than current profitability. This guidance helped ease some concerns surrounding Intel's current losses. If data center and foundry growth continue accelerating into the second quarter, market sentiment around the stock could shift very quickly again. Against this complicated earnings backdrop, Intel's after-hours price action became a perfect example of how divided the market still is. Immediately after the earnings release, quantitative trading systems aggressively bought the stock based on the stronger headline numbers, sending shares up more than 15% after hours. But as investors focused more closely on Intel's GAAP losses, weak PC growth, and long-term cash flow pressure, the stock quickly gave back most of those gains. That sharp reversal clearly showed how deeply divided Wall Street still remains on Intel's turnaround story. The sharp rally followed by the immediate reversal tells you one thing very clearly: market confidence remains fragile. Short-term traders are focused on earnings beats and growth acceleration. Long-term investors are still focused on profitability, cash flow, and whether Intel's turnaround strategy can actually succeed. And in this kind of highly divided environment, emotional buying can quickly turn into serious downside volatility. Overall, this highly divided earnings report gave both bulls and bears plenty of ammunition. Bulls saw a strong rebound in AI data center demand and meaningful progress in Intel's foundry commercialization efforts. Meanwhile, bears remain focused on the company's heavy GAAP losses, enormous capital spending requirements, and long-term profitability concerns. And the one thing most of Wall Street seems to agree on is this: Intel's massive transformation strategy is still far from complete. Although this quarter's revenue beat helped stabilize investor confidence for now, Intel still faces major challenges involving foundry profitability, advanced manufacturing competition, and long-term cash flow pressure. Now both the bullish and bearish cases are clear. The big question is whether Intel can truly complete its turnaround over the next few quarters through Xeon 6 and its foundry business, while improving profitability. So what do you think? Are you still bullish on Intel, or becoming more cautious about the risks ahead? Subscribe to Deep Dive Stock Earnings. See you next time.